Welcome to the Vineyard Global Advisors 2021 halftime report. As Eric said, my name is Tom Samuelson. I'm the Chief Investment Officer of Vineyard. I've got about 25 minutes of prepared comments, and like Eric said, we'll open it up for Q&A after that. 2021 is playing out pretty much as we expected in our year-end review, and we've been discussing since the spring of last year. We've got a very strong global economic recovery underway. I've chosen this photo of a vineyard kind of in the sweet spot of its growing season because that's where we find ourselves with the economic recovery and the price action in the stock market. We're in the sweet spot of the economic recovery. And our tagline coming into this year was "Ride the Wave," by which we meant Vineyard strategies were fully invested because we thought there was a strong likelihood of a continuing bull market, which is what we saw in the first half. Most major indices posted strong gains, and our strategies posted strong returns because of it. So with that as an introduction, let's dive a little deeper. This is the global economy. This is from the International Monetary Association, and on your left is the growth rate that's expected for this year. We're expected to grow at 6% this year. Usually the global economy grows at about 3%, so this is double, the historic growth rate, and it's broad. So the advanced economies like the US and Europe are going to grow at 5%, and emerging markets are going to grow at close to 7%. Usually advanced economies like ours grow at 2 to 2.5%, so again, double the growth rate. And emerging markets grow at about 4 to 5%, and we're pushing 7%. So really, really good backdrop for investments, because as the economy recovers, corporate earnings recover, and that's what we're seeing. And corporate earnings going higher provide the fuel for stock prices going higher. Now, I spent some time on this on a webinar we did recently, and I want to go over this. This is, I'll give you a 30,000-foot view of where we think we're at. And what I've shown here is the economic cycle in the lower portion and then the stock market cycle in the upper portion. I think it's important to understand how these two interplay. Excuse me. We typically on the economic cycle, we have a recession like we did last year with the COVID pandemic. And businesses start to lose traction, they start to lose business, they lay off workers, that affects consumer spending, and the economy spirals down into recession. But eventually, inventories are depleted, companies need to build back those inventories, they hire back workers, consumer spending picks up, and off we go onto another business cycle. And that's where we are now. We're 1 year into this. The recession ended in April of last year. So we're a little over 1 year into this, 15 months. And typically these cycles last about 4 to 5 years. Some are longer. If you remember the financial crisis in 08 and 09, that was a severe recession. And then we didn't have a full-blown recession until the pandemic hit last year. So that cycle lasted 10 years. So from a business cycle perspective, we're still kind of early days into this recovery. Again, 4 to 5 years would be typical. What the stock market does, though, is it anticipates the recession, the end of the recession. It starts sniffing it out, and it bottoms before the end of the recession, usually 1 to 6 months. This time it bottomed 2 months before the official end of the recession. And then off it goes. It anticipates better times and better earnings, and it doesn't mean it's always this clear sailing for the stock market. There's typically what's called an echo bear market. So this is a non-recessionary bear market, and if you look back at 2009, we didn't have another recession until last year, but we had the European sovereign debt crisis in 2011, then we had the global economic slowdown in 15 and 16, and then we had the Fed starting to raise rates late in 2018. All of those cause like shallow bear markets, so declines of about 20%. You know, a bear market is defined by a decline of 20% or more, and if you have a bear market with a recession, it's more like 30 to 40%. Really severe bear markets like the dot-com bust and the financial crisis, go down 50%. So there's usually some event in between these recessions, whether it's a sovereign debt crisis or a global slowdown, that causes the market to dip on the order of 20%. We still don't think we're there yet. We may see some gyrations this year. We may see a 5 to 10% type pullback in the second half, but things are looking pretty good, and we think we're still early for one of these echo bear markets. One of the reasons is we have continuing record high spending from governments and central banks around the world. So we've got this kind of Goldilocks scenario where the economy is recovering from a severe recession that we had last year. It was the worst recession since the 30s. And governments are spending, and they're spending at record levels. So they're not really backing off. We just yesterday passed a $1 trillion infrastructure package in the Senate. Still has to be approved. There's also talk of a $3.5 trillion social spending program as well. So we've already spent trillions, and the likelihood is we will spend more. We're going to run a deficit of $3.9 trillion this year. That's also a post-World War II record. And again, it's happening as the economy is recovering. So we're kind of supercharging this recovery. Any country in green is spending more than 10% of the size of its economy to contain the COVID pandemic. And of course, we have the Delta variant now, and there's concern about that. So a lot of this spending is continuing. Now, I added this because the U.S. is in green. It's over 10%, but I mean, that's way, way over 10% is what we're spending. If you go back to the dot-com bust in 2000, okay, between the fiscal spending, which is what our government spends, and then the monetary stimulus, what our central bank prints, in effect, we spent 0.2 trillion to contain the fallout from the dot-com bust. That's on the left. That was about 2% of the size of our economy. Now, come to the great financial crisis in 2008, we spent $2 trillion, and that was about 14% of the size of the economy. We're 5 times that already. We're close to $10 trillion to contain the pandemic. So that's 44% of our economy. I mean, you're pushing half of the size of our economy in terms of stimulus, and that is adding to the recovery that we're seeing. So pivoting to the stock market, we had a good first half. The market was up over 10%. And over the long run, the stock market, the S&P 500 gains about 9 to 10% a year. So we've already had a good year just in the first half. And you might think that, okay, well, then we probably give some back in the second half. But as many things in the stock market, strength begets strength. And typically, what I'm showing here is going back to World War II. These are first years that have over a 10% gain go on to post another 10% gain in the second half. There's no instance of a bear market. I mean, this fell shy of 20% in 1987, but overwhelmingly the preponderance is for continued strength into the second half, and we're up 3% already thus far into the second half. Oops. Technical difficulties. There we go. Okay, so that doesn't mean that we're going to wait for the market to decline 20% to say, oh, okay, well, the bull market's over. I mean, there's a range of indicators that we're monitoring. I think a lot of you have heard me talk about these. One of them is what's called breadth. So breadth is the number of individual stocks that are participating in the broader trend. And we want to see broad participation because that means the trend has support. And what I'm showing here is the breadth of the S&P 500 going into the dot-com peak in 2000. And you can see it was deteriorating. It kind of gives you, it's the canary in a coal mine. It's giving you a heads up that the bull market is likely to end because fewer and fewer stocks are participating. And that's exactly the opposite of what we see right now. These advances are broad. They're being supported by a majority of stocks within the broader indices. And you know, there's other indicators we're looking at, but this is the general message we're seeing. That you've got a good bull market, and it's supported by breadth and a range of our indicators. Now, I want to pivot to the performance in the first half of the year. Maybe a little difficult to see, but I know a lot of you are in the Russell 3000 Enhanced Dividend Strategy. That's a portfolio of high-quality dividend-paying stocks. That's on the left here, so that was up 16.5% in the first half of the year. Over the long run, it does about 15%, so very strong first half performance. I won't go through all of these, but the dynamic yield, I know a lot of you are in that. That's a stock bond blend portfolio. These are all our income strategies. That was up 10.5% in the first half. Over the long run, it does 10.7%. Here I'm showing relative to their benchmarks. They performed well in the first half. So good gains from all our income strategies. Some of you are in our asset allocation strategies. They manage risk by having a broadly diversified portfolio across 9 different asset classes. They had strong participation. They were up 9. Advantage Plus, these are the 70-30 models, so 70% equities and then 30% fixed income. They were up. Advantage Plus was up 9. Allocation uses, we look for top performing mutual funds and then organize them in a fashion that gets you 70% equities. That was up 9.4%. And then our ETF strategy does the same thing, 70% equity exposure sourced by exchange traded funds. So that was up 9.6. These were slightly behind their respective benchmarks. As the economy recovers, typically interest rates will rise. And we have been cautious about a rise in interest rates, and because of that, we've had less interest rate exposure, and interest rates declined in the second quarter of this year as fears about the COVID, the Delta variant came out. So some of our cautiousness on the fixed income side wasn't rewarded in these models, but still they had solid first halves. And then lastly, I want to pivot. We've designed a few new strategies here that were developed to participate in a broader range of market conditions. Over the last 2.5 years, growth stocks have been in favor to the detriment of value companies like the dividend index. The Dow Jones Dividend Index was down last year, down 5%. Our dividend strategy was up 5%, but dividend payers and value stocks have been out of favor. There's been a lot of excitement and enthusiasm over cloud companies, and they've reached really stratospheric valuations. Not all of them, but we've developed a range of strategies still within our risk-managed framework that are designed to participate in a broader range of market backdrops. So I'll start with our enhanced S&P 500 strategy. We've run this for 6 years. That was up 14% in the first half, and over the long run, it does about 15%. The first of the new strategies is what we're calling Optimized Equity Alpha. Big name. What it does is it combines 2 different strategies. One, a sector rotation strategy that is focusing on the best sectors. So like last year, it would have been technology and consumer discretionary. And then we pair that with a flexible style approach. So 60% is in sector rotation, and then 40% is in either growth or value, whatever in favor. So that was up 21 for the first half, does 17% over the long run. Our sector rotation, this is comprised of these 2. Pure sector rotation was up 26% because that can use a little bit of leverage. All sectors are doing well right now, and it uses a little bit of leverage. That was up 26%. Style Flex emphasized value companies, but it still has some growth companies, up 13%. And then the quantitative value is a rules-based pure value approach. And value stocks, as the economy recovered, they're economically sensitive, and they came back in favor. That had really a great first half. That was up 34%. So let's pivot a little bit to the outlook now, moving into the second half. And it's almost like the adage, be careful what you wish for. Because in the first quarter of this year, the market was concerned about an overheating economy. and then the Fed would have to raise rates and take away the punch bowl, and that could be a downer on the market and eventually the economy. So everyone was cheering for a slowdown in the economy. And then in the second half, we had the Delta variant pop up, and that did start causing some slowdown, and it brought interest rates down. And then the market started worrying about, oh, okay, well, we're going to have another shutdown. So we had this kind of interplay, or the seesaw between, too hot of an economy and then economy maybe that's slowing down. But from our perspective, when we look at the indicators that would kind of go beneath the covers of the news and the pundits and the price action, if inflation is really going to take off over the long run, we're going to see that in things like break-even spreads and implied inflation rates in the market. And you've got a 30-year bond that's giving you like less than 2%. I mean, people, if we're really going to have runaway inflation, people are going to demand more than 2% to own a 30-year bond. So we're just not seeing, even though we had an inflation print today that was up over 5%, and last month it was up over 5%, and you probably noticed it filling up, at the gas station or buying food. There are commodities like lumber. Lumber has dropped 70% since May. It's actually down now year to date. It's down 30% year to date. So the COVID has disrupted supply chains, and as those come back, supply will come back. And we think there is a transitory element to inflation. And we'll take our cues from the market indicators, but they are just not telling us that longer-term inflation is a problem. On the other side, if we're really going to shut down the economy again, things like credit spreads, the yield of higher risk bonds would start expanding, start increasing, and they're not. They're very stable. And we saw that right before the crash of last year as we went into the pandemic, that the riskier bond categories start signaling that we're heading into another downturn, another recession. We're not. I mean, it looks balanced to us right now. And you always are cautious about saying Goldilocks, but I mean, right now things continue to look pretty good to us. Another concern of the market is valuation. We've had a good run from last year, and we look at many valuation statistics, and a number of those are formalized in our models. And I'm just showing the average price earnings multiple of the S&P 500 here, going back to 1995. That red line is the average. This is the average company within the S&P 500. The S&P 500 is a market cap weighted index, so things like Amazon and Facebook and Google get disproportionately weighted. But if you weight every company the same way, you kind of get beneath the so-called FANG stocks. And over the long run, the S&P sold at about 18 times earnings. And you could say, if you wanted to make a case to say, okay, the market's crazy expensive, you could take last year's earnings, which were depressed because of the recession, and then the current price divided by those earnings, you're selling it, it's expensive. It's selling at 33 times earnings. But if you look forward, like the stock market does, those earnings are accelerating. We're going to be up 60% this year. We're going to be up 10% next year. Over the long run, earnings grow at about 6 or 7%. So we're seeing really strong earnings acceleration. And when you do that, you get this dashed line. And we come down to trading on next year, we're actually slightly cheap relative to the long-term valuation of the market. So, I mean, we come out that we're around fair value on the market. If we got up to 4,600 on the S&P 500, right now we're about 4,400. I think valuation, the risk of some pullback to reset valuations is elevated, but we're around fair value on the market. There's certainly pockets of overvaluation. Some of these cloud companies are selling at 40 times sales, 40 times sales, 200-300 times earnings. But as we get to 4,600, I think valuation could be more of a headwind for the overall stock market. The other risk, we've talked about this since last spring, is geopolitical. And on the left there is President Xi Jinping of China, and then that's a satellite view of Taiwan, which is off the coast of China, and then President Biden is on the right. And there's friction between the US and Taiwan. Taiwan is home to 50% of the world's semiconductor manufacturing. That's a key input. It's one of the commanding heights of the global economy, the 21st century economy. And China wants to exert greater control over Taiwan. Taiwan is an ally of the United States. We thought because of the Summer Olympics and PR purposes, we wouldn't see any friction escalating over Taiwan. But now that the Olympics are over, this may resurface, and it could lead to sanctions if China exerts greater control, and it could lead to another trade war. So it's something we're monitoring closely, as many of you are, I'm sure. And but for now, we're not seeing it showing up in the indicators that we monitor. I also wanted to spend a little time just to frame volatility. We're coming out with a piece, the normalcy of volatility. You know, we don't. There's an old adage: volatile markets aren't good, and good markets aren't volatile. Well, that's true, but there's a band. Generally, you know, 90% of all years have 2 to 10% pullback. So it doesn't mean the bull market is over just because the market pulls back some. And what I'm showing here is the blue bars are the returns of the stock market going back to 1980. And then anything below this black horizontal line is a down year. So the yellow dots represent the amount of pullback you had in each one of those years. And you can see the average year has a 13% pullback, yet 80% of those years finished positive. So it doesn't mean you head for the hills just because you have a 5 or 10% pullback. Now, of course, every bear market or crash begins with a 5 to 10% pullback. So how do you know the difference? And these are the indicators we talk about. Here, this will be on the dashboard of our newly designed website is coming out here within the next couple weeks, and we'll have these indicators posted every day. These are the short-term indicators. They're actually neutral right now. We're a little bit ahead of ourselves in the market, not a concern. The longer term is still solid. Every one of these indicators, which we've evaluated over many, many years and decades, and when they're bullish, the market tends to give you good returns. Every single one of them is green, so we're in a maximum bullish condition for the long term. Very solid. We could see some pullback, but as long as these indicators hold up, we would expect the bull market and the uptrend to continue. Yeah, long term is a year. So the trend, for example, that's been in place since the market bottomed in March of last year now is over a year long. So it's that trend we're talking about when we talk about the long-term trend. So the short-term trend is three to 5 months. And so we could see we've generally had a pattern to simplify this. We've had a pattern of higher lows and higher highs since the market bottomed in spring of last year. But we could pull back and still stay above the last pullback. So then you continue to have a pattern of higher lows and higher highs, which defines a trend. That's the idea behind it. And I'm showing here these range of indicators. In 2019, if you remember, Trump ratcheted up the trade war with China, and there were jitters in the market over that. And here's an 8% pullback in May of 2019, but our short-term and our long-term indicators were saying things are fine. So that turned out to be just an 8% decline, and the market went on to make higher lows and higher highs. Now, coming into the pandemic, to be honest, we didn't fully appreciate the global breadth of the pandemic, but we're keying off of this. These are our indicators in February. Here's our 8% decline. They were bearish. There was a lot of deterioration in the volatility curve, in the breadth, and we were very concerned. And as you know, we moved into March, it became clearer what the concern was, what the potential extent of the pandemic could be. But it was flagged. It was flagged by our indicators, and this was an 8% decline that did indeed lead to a crash. I mean, that was the worst drop we've seen since 1987. So that's, hopefully that dives under the covers a little bit, shows you how we think about and objectively evaluate risk in the market. And then our strategies will raise cash to bring defense onto the field in effect. And our strategies went down a whole lot less than the market during that crash period. And because of that, they had a shallower hole to dig out of, get back to making money. And it also, there's an emotional side to volatility. You know, when your nest egg goes down a lot, it can get you to do the wrong thing. You're just like, I don't want any more of that. Just get me out. So we're risk managers. We are purposely trying to give you a smoother ride, but then participate in the upside that the markets offer. So with that, I think the summary would be a very strong economic recovery is underway. We're in the sweet spot of this economic cycle. We're about 15 months into it, a little over a year. These usually tend to be 4 to 5 years. We think we're even early for one of these echo bear markets, but we're watching it closely. It could be geopolitical. You know, you're never quite sure what can cause that. It could just be the markets getting ahead of themselves. If we get north of 4,600 on the S&P, valuations are stretched. We'll probably raise a little more cash just to have some added protection. These COVID vaccinations are rolling out. I think 71% of the U.S. now has received at least one vaccination. And why the Delta variant is causing a case count to go up, we're not seeing the hospitalization and deaths go up like we saw last year. This government spending is continuing. I mentioned $1 trillion of infrastructure that was approved yesterday, and additional spending could be coming. We don't know the final shape of it, but there's a lot of money out there, and our Fed is injecting $120 billion a month into the economy, and we'll see. They're going to rein that in, but they're going to taper that so that all that money they put out into the economy is still going to stay out there. Spare productive capacity is likely to make a significant portion of the inflation transitory. So I've mentioned the risks we're monitoring, geopolitical, valuation, and then uncertainty. Eventually, the Fed is going to take away the punch bowl. And but you know, when the Fed hikes interest rates, the market historically has gone up another 7 to 8% over the next 12 months. So it's not the end of the bull market just because the Fed is starting to take the punch bowl away. So we remain close to our benchmark exposures. We've taken a little, we were overweight. So what I mean by this is, let's say you're in a 70-30 model, so that would be 70% equity exposure, but we have discretion to dial that down to 50% or dial it up to as much as 90%. We've been more than 70% since the spring of last year. We're starting to pull that back. We're around 65% or so because we're getting slightly overbought. We're also into the seasonal weak time of the market. Generally, August through October is the weakest seasonal time for the market. We're over with the Olympics. We're concerned about geopolitical. So we think it's prudent to just dial back some of that exposure where we've been overweight since the market bottomed. And then, you know, if risks escalate, hopefully I've given you a sense of how our indicators work. We'll adjust just as we did before the market crashed in 2020. So with that, we can open it up for some questions. Yeah. Or do you want to monitor?
Hold on one second, Ken. Real quickly, everybody, I want to have a little bit of a format here. I'm going to ask Tom about 2 points, if that's okay, Ken, just to hold your question. I want to ask Tom about 2 points that I would like him to touch on and cover a little bit. And during that time period, anybody who is watching this virtually, email me questions. I will look at them and then ask them after the live audience has had a chance. That way people at home get a chance to hear Tom comment on my stuff, the live questions here, and then I will do the rude thing that Herb never wanted me to do, which is look at my phone in public as I read everybody's questions from abroad. So with that being said, just give me a moment here. Tom, one of the things I was hoping you could provide some insight on is, you know, you've got your short-term models where, you know, neutral, I think is where you had them at.
Mhm.
Can you discuss two things? First off, the impact of what unemployment could look like when some of the benefits run out. I think they're set to expire in September,
Mhm.
unless Congress changes something. So if you could discuss how that could happen, are there going to be enough jobs for people to go back to? If there's, do you see a huge influx? Just touch on that a little bit. And then the other thing is, we've seen the housing market really kind of explode this last 15 months or so. It has become a seller's market through and through. We talked about it last night, some of the things that we're
Mhm.
seeing out there. So if you don't mind commenting a little bit on a residential real estate market, as in my opinion, just if it's peaking or not. But then also another layer to that is the um, rent issues that are out there, as far as you can't evict somebody that seems to
Mm.
be extending a little bit, and not to get into the legality of it, but just how it
Mhm.
could impact personal real estate overall, rent, inflated home
Right.
purchasing, and then the unemployment. So if you don't mind commenting on
Yeah.
that, everybody at
Okay.
home, email me some questions, and everybody listen to Tom while I step aside for a minute.
Right. So let me take the second one first, because we own some home builders have, and they've been very good stocks. Right now, the existing and new home supply is about 2.9 months on the market. So the longer term average is about 6 months. That's normal to have 6 months of supply. So we're still half of the normal supply. You've got demographics that are favorable. Millennials are getting married, having babies, wanting houses. So there's demand for housing. Interest rates are still low, and while we expect interest rates to rise, we're not expecting them to uh, get materially over 2 to 2.5%. So you're gonna have continued low interest rates, continued low inventory on housing, and then lumber. Lumber too is coming down. Lumber's down 70%, now down 30% year to date. I was talking to a home builder. I live in Denver, and Denver's exploding with building. He was saying that the actual amount of lumber in a house is more like 10 to 12%. So he wasn't seeing that much of a problem, even when lumber was higher. But you do have lumber coming down. So I think residential for us for owning home builder stocks, I still think it looks solid. Um, and the landlord issue, coming to the airport, I was listening to a landlord, small landlord in New York City, and the moratorium on evictions has been really affecting him, and that I believe was postponed again. But I think that the latest one ends in September. And he was saying, yeah, but okay, so um, people are getting payments from the government, which do end in September, and then they're also not paying rent, and you can't evict them. So, and what's going to happen is then you'll go to court, but the courts will be backed up. So it's like a year and a half before your cases are going to be heard, and he was saying he's facing bankruptcy. So, um, I'll just mention that as uh, anecdotally. And sorry, Eric, the first question was on employment. Yeah, the
Unemployment with the benefits run out, where do you see, the percentages lying? I think it's at 5.5 now. But
y-
then are there going to be the jobs?
yeah, there's 9.5 million unemployed workers, and interestingly, there's 10.1 million job openings. So there is a mismatch between skill sets for some of it. But I think when the unemployment benefits run out, then there's more incentive to go back to work. So that labor pool, especially in retail, I think will open up. And that's some of what we saw in the transcripts of the second quarter earnings from selective retail companies.
All right. So group here, Tom, they can ask a question. Repeat their question before answering it, please. So that way I don't have to keep queuing the mic on and on. So,
Gotcha.
I think you had one.
Yeah.
Yeah, I was surprised you didn't talk anything about national debt. I think there's a lot about
Yeah.
significantly.
It is. It's some. Yeah. Oh, sorry. The question is on national debt, and it is increasing. We're running a 3.8, $3.9 trillion deficit this year, and we are down the path of modern monetary theory, which is the notion that you can live beyond your means and have your central bank print the money and buy the debt. And there's at some point, many economists and very successful investors have pointed out that ultra loose monetary policy sows the seeds of a speculative bubble, and then there's always fallout. I mean, that's what you saw in the dot-com bust, for example. And I think there's pockets of that now in these hyper cloud companies. And it's really exciting. I mean, it's the fourth industrial revolution between artificial intelligence and cloud computing and autonomous vehicles are coming, and they're really exciting technologies, but they're priced to the moon. So I think we're seeing that, and that's being accelerated by all the money that is out in the economy. But as we think about this, I mean, Japan's debt to GDP is over 200%. I mean, we're a little over 100%. So this can go on for a while, and the risks, the most apparent risk is inflation. As you devalue the currency, you have to pay more for goods, and so we're watching closely. There's a point where this could matter. It could blow a speculative bubble, but our Fed's balance sheet is now $8.7 trillion. So what do we mean by the Fed's balance sheet? The Fed prints money and then buys assets from the economy. In the financial crisis, it swept up a lot of bad debts. So it wanted to keep the banks liquid. If you remember, in the Great Depression, 5,000 banks went bankrupt. That made the Great Depression worse, made it great. And Bernanke was a student of that, and he wanted to make sure that the banks didn't fail. So the Fed supports them by pumping liquidity into the economy. But we're a $23 trillion economy, and we've got a Fed balance sheet now that's 8. So this can go on. This can go on for quite a while. I mean, like Japan's balance sheet has already passed the size of its economy, and they've gone to a point where now they're the biggest holder of Toyota Motors is the Bank of Japan. I mean, we're still just buying generally mortgage-backed debt, federal debt. The Fed tiptoed with this last crash last year into buying some exchange traded funds of fixed income, investment grade fixed income. But if you follow the bouncing ball and they go to where Japan has gone, then they will eventually support. They'll be buying stocks in the market. This can go on for a long, long time. Is how we look at it, how I look at it, and why there's risks in that. Like I said, a speculative bubble, inflation. That's something we're watching closely. I think that will show up in the longer term indicators, and there's some of our indicators are the I don't want to be too wonky here, but the term structure of volatility. Volatility is the fear index, and you hear it talked about on the nightly news. They're usually talking about the front month volatility. We look at the whole curve, and when the front month rises well above the longer term, 6 months out, that's been a very good signal that risk is escalating. It's been an incredibly good signal, and it's just one of many we look at. And things like that, like credit spreads and the kind of indicators we look at, will start flagging when the risk of a speculative bubble unfolding is high. And then, like I said, on inflation, we're just not seeing it right now. We're not seeing the 30-year bond would be more than, it's actually less than 2%. It's like 1.98%. So if the economy was really, if the market was really worried about long-term inflation, you wouldn't have buyers buying a 30-year bond for less than 2%. Yeah, Mike.
How would you put into context the climate change situation in regards to what you just said?
How do we view climate change?
Well,
Broadly, yeah, I know the UN just came out with their report, which was fairly alarmist. I know that you're down a path that is not going to be reversed. I mean, the push towards electric vehicles is coming. We've been very reluctant on energy, fossil fuel companies. I think there's regulatory headwinds. I think uh, it's it's this kind of, we owned energy companies early this year because there's this conundrum of, if you don't encourage more supply, open federal lands for drilling, and then you will dry up supply. And 80% of energy comes from fossil fuels right now. So we need a smooth transition to wind and solar, and so we knew that if you're not encouraging oil and gas supply, you could see a rise in oil and gas prices, because most of the car fleet is still gasoline, and that's what we saw. So we owned energy stocks earlier this year. I think oil may peak out at, it got up to like 78, 79. I think $80 incentivizes shale drilling on private lands, and there's still a bunch of drilled but uncompleted wells that they can bring on. So we expect to see oil production start to ramp up again. And OPEC's got 9 million barrels a day of shutting capacity. So again, there's another commodity I think will come down, and inflation effects will be transitory. But I think as the world pushes towards lower greenhouse gas emissions, those are 2030 and 2035. So that's still a ways out there. We'll see how much of the new Green Deal gets passed and what that could mean for companies. I mean, there's a regulatory burden of some of those costs, and from my perspective, that could cause earnings to decline, and that could be a negative for the stock market. But I think we got to see that play out.
So shouldn't we be looking at other options?
So shouldn't we be looking at other options for energy? And yes, but a lot of those companies are highly speculative. Ballard Power, for example, has lost money for years and is expected to lose money for the foreseeable future. So they're very expensive companies. I think there are utilities that we look at and we own. That's a more reasonably valued way to look at it. We don't know how the midterm elections are going to go. Let's say the pendulum swings back the other way, then we postpone some of the alternative energy growth. For we and like I touched on the 5G and all the kind of exciting new technologies of the future, but the way they are priced right now, we think there's quite a bit of risk in them. And those kind of companies, a lot of their value, and we were just redoing this week. A typical growth company gets over 80% of its value from its earnings and cash flow that start 10 years out into the future. So when interest rates rise, you discount back those earnings that are way out there. A growth stock will get hit 4 times as bad as a value stock. And I think some of those stocks fall into that category. If we were to see a major correction in them, there's one called Bloom that I think is interesting. Eric was talking about it. They do catalytic converters, fuel cells, and I'm impressed with their traction. eBay and Google and a number of warehousing facilities are using their converters, and it takes natural gas as the input, and it doesn't combust it, so you don't have the nitrous oxide and sulfur dioxide emissions, and it creates power. And they've been showing pretty good traction, and they have a reasonable valuation relative to their growth. So we look at a lot of these. We just can't get comfortable with the valuation on most of them. Yes.
Why we subsidize wind power, solar power, and they're that good, they should be able to be doing well on their own. When we were in Pennsylvania, there's a track of 6 windmills high on the mountain. And twice now when we've gone, they haven't been turning. And each one costs $1 million. And they only last 20 years. And then you can't recycle them. They're not recyclable.
Right, and they cause damage to birds as well.
I don't understand why we're putting all this money into subsidizing. If they're that good, they should be able to do it on their own.
Yes, well, this is what Eric was talking about. That is more of a political statement. I mean, I will tell you the reason is because of concerns over global warming and the policy choice to make a faster transition to a cleaner energy world. So that's the reason that you're subsidizing them. Coal is the cheapest energy source. I mean, and natural gas is right there, and we've made a lot of strides in terms of clean air because we've replaced coal with natural gas. And I always thought that would be the bridge fuel to. I mean, the technology keeps getting better and better with these alternative energy sources, be it wind or um, uh, you know. Solar cells keep becoming more and more efficient, but you've got cheap fossil fuel, and natural gas is cleaner than coal. And but this is the world we find ourselves in. I mean, this is the debate in Washington and the politics of it. That's the reason you're subsidizing it. um, yeah.
All right. So Tom has just scoot over there. I'm gonna
Okay.
grab a. So we have a few questions from people online. Uh, Two questions I'm just going to tie into one, and it's about sectors. Somebody has a question asking you to comment on the forecast of the tech sector. Is it overbought? Is it overvalued? If somebody wants to, I guess, entertain the idea of dabbling. And then same thing with travel sector stocks, airlines, cruises, hotels, that sort of thing. Where are we specifically on those sectors as far as peak, bottom?
Right. I think with technology first, that's one of our top ranked sectors in that sector rotation strategy. It continues to be. We're a little concerned about some of the valuations there. There's pockets, again, with those hyper cloud companies, which we don't emphasize. And then within the S&P 500, the FANG stocks, Facebook, Amazon, Google, Netflix, Microsoft, FANMAG is another acronym for them. Don't Relative to their growth, they don't seem really that expensive to us. I mean, Facebook is around 20 times earnings. Microsoft is at 38 times earnings. If you adjust for how low interest rates are, we can get a growth multiple as much as 39 times earnings if you're going to grow at 25%, which a lot of those companies are. So we like the tech sector. I think you could still see some pullback, but we like it. It's one of the top sectors in our sector rotation model. The reopening plays, which the hotels and airlines, cruise lines all fall into. We own some hotels. We are waiting for a pullback on some of the airlines. I think the restaurants are really interesting. We own a couple of those. And it even goes, it kind of gets to your question about playing clean energy. It's like we don't want to pay those high multiples of some of the most obvious companies, but there's ancillary plays, and one of those plays was Cisco, the food company, because it pays a great dividend. They've got lots of cash flow. They've grown the dividend at a good rate, and as all these resorts and hotels open up, they have a dominant position in that. So that's a way to play a theme, like the question was about, and not pay a really high multiple where there's risk of disappointment.
Kind of also on that too. I notice sometimes I use this example in client meetings when you all own the position of Texas Instruments. We've known about that company our whole lives in this collective room, but when's the last time anybody ever saw a commercial for them? But they're in so many different things, kind of like with the Cisco model, supporting that. So next one, I think is kind of relevant with what is happening right now and how we need to look at this maybe short term as we go into the holiday season. There's a lot of chatter right now about the Delta variant specifically. And again, this kind of touches on a topic that is very, everybody has an opinion on. Okay. So specifically to the Delta variant and the spread at which it's seeing. We saw it spread earlier through other countries, and we're seeing it here now. How are you all observing the potential impact of it, i.e., as far as what is it going to look like what happened 15 months ago, or is this going to be what some people have talked about? Is this a weaker strain? Is it the strain the same? And I know you're not a doctor by any means, but how are you guys evaluating potential risk either way in what is
Right.
being seen as far as its spread, and if you're viewing preparations for things as bad as shutdowns again, or so on and so forth?
Right. So I touched on this a little bit in the formal presentation. I mean, we track the COVID numbers every day. And I know the Delta variant, for example, in the UK skyrocketed. But now that's peaked. And it's peaked at a lower level from the pandemic, the variant from last year. And generally, that's what we're seeing around the world, too. There are countries that have been at the kind of forefront of the Delta variation, and now it does look like it's peaked. And here in the U.S., the case count has gone up, but the deaths have not. So we are 71% at least partially vaccinated. There's mixed reports on the efficacy of the vaccines on the Delta, but we're not seeing it in terms of the deaths and the hospitalizations ticking up. So from my perspective, if it is going to escalate into something like another global shutdown, we're going to see that in a number of these indicators. The one is credit spreads. Credit spreads will start widening. The market will start sniffing out that a slowdown is coming, and we're not seeing that. We're seeing very stable credit conditions right now. So we'll take our cues from our indicators. But the risk right now of another shutdown seems low.
Next question, just had to answer this one. The new website, you'll be able to pull performance reports from it. Just so you recite that.
Yes, yeah, we have that on our portal now, and then we'll have that on the newly designed website as well, and that should be within 2 or 3 weeks. Yeah. Yeah.
So I'm out of questions online, and you all are out of questions here. Tom, thank you very much for coming. It's always a pleasure. He'll be hanging out for a little while if anybody wants to do a little one-on-one chatter, but thank you very much. Thank you, Tom.
Thank you.
Okay, so we've cut the live feed now.